Hello everyone, I'm Ankit. You're watching StudyIQ IS English. In our today's video, we'll deal with a very complex topic from the subject of economics. But as you can understand, from watching our previous videos, we try to make these kind of technical topics very easy for you to understand. Now, the subject matter of our today's discussion is what will be the impact of the increase in policy rates by the US Federal Reserve on the Indian economy. And the reason why we have picked up this topic for our today's discussion is because last week, the US Federal Reserve's Federal Open Market Committee, which is the US equivalent of India's Monetary Policy Committee, they have decided to hold its benchmark interest rates called as Federal Fund Rate steady at 3.5 to 3.75%. So basically what I try to say that the US Federal Reserve has kept its benchmark policy rate the same. But this is not what is surprising. The surprising matter is, in its indication, the Federal Reserve's head has given an indication that there is a possibility in this very year that going forward, the US Federal Reserve would increase the policy rates. So what will be the impact of this increase in policy rates, first of all, on US economy? This we'll try to understand. And more importantly, from our today's discussion perspective, we'll understand how this impact would trickle down on the Indian economy as well. As I've told you, I'll try to make this topic as simple as possible by deducting what the news articles are actually reporting. Now, first, let us try to understand what will be the immediate impact of this move on the US economy. As this write-up suggests that the latest policy rate or the indication of the US Federal Reserve has led to increase in yields on short-term US treasuries to a 16-month high. So what is this increase in yield? The yield is basically, it is referring to bond yields which move inversely in relation to bond prices. So what are the basics with respect to bond prices and bond yields? Let us try to first understand that. Now, as you can already understand, a bond is a financial instrument which is issued by governments as well as corporations in order to borrow money. And bonds have three characteristics: a face value, maturity, as well as coupon rate. So suppose a US government issues a bond of face value of $200 with a maturity period of 10 years and it is offering a coupon rate of 10%. So this would mean that the interest payment that the US government will make to any bondholder, you, I, or any third person, would be the $20 every year would be your interest income if you invest in these bonds. Now, when the US government issues these bonds and a primary investor buys it directly from the US government, they will pay the bond price that is equivalent to the face value, and as a result their interest earned on these bonds will be $20. As I've told you, government anyhow says that I'm going to pay a fixed amount of interest rate which is coupon rate multiplied by face value to any bondholder. So if I've bought that bond from the primary market, how much will be the interest I will earn? I will earn $20 interest. So what will be my rate of return on this investment? My rate of return on this investment would be the interest earned divided by the price I've paid for that instrument multiplied by 100, which is 10%. And this rate of return is what is highlighted and called as bond yield. So how much rate of return I'm making it on the bond? It is called as bond yield. So how much is a primary investor earning by investing in US government's securities? That is 10% of bond yield. So what do you understand from this discussion? You understand that for a primary market investor, the bond yields are always same as the coupon rate, right? So this is our inference in the primary market. Now bond yields, as I've told you, go up and down, but this doesn't happen in the primary market. Primary market is a market where you buy the security, shares, stocks, bonds, etc. directly from the issuer. But there is also a possibility that a buyer or a owner of a financial instrument might sell it in the secondary market, that is stock markets, right? So let us understand how stock market transactions actually affect the bond yields. Now there are two possibilities. Suppose if I'm an investor in the bond and I want to offload that bond before the maturity date, so I can sell this bond in stock market at a profit or a loss. So these are the two scenarios that can realistically happen. So suppose if I take a financial hit and I sell this $200 का फेस वैल्यू का बॉन्ड इन अ यूएस मार्केट, इन अ सेकेंडरी मार्केट at a loss of $190. So how much is the bond price any secondary investor has paid to me? That is $190. But how much interest rate that person will earn from the government? He is going to earn irrespectively $20 from the government. So how much is his rate of return on that investment? $20 divided by the price he paid, $190 into 100. So it means the bond yield for a secondary investor who has got this bond for a discounted rate from me increases from 10% to how much? 10.52%. Right? Now let us consider the second scenario. What was the second scenario? Second scenario is the case where I have sold that bond at a profit of more than the face value. So suppose if I offload that bond at a profit of $10, which would mean a secondary investor has paid how much money for that bond? $210. And how much interest he is earning from the government, which remains fixed? That is $20. So now calculate his rate of return and bond yield. It will be $20 divided by $210, that is his bond price, into 100, which would give you a bond yield of 9.52%. Understood? So what do you understand from this discussion? Depending upon the factors of demand and supply, which would determine how much money worth of bond I've sold in the secondary market, the bond yields actually change. And what is the relation between bond price and bond yield? As you can understand, as bond price decreases from 200 to 190, the bond yields increase from 10 to 10.52%. So the relation between bond price and bond yield is that of an inverse relationship. Understand? Similarly, take case of the second scenario. In that scenario, the bond prices are increasing from $200 to $210, but the bond yields have reduced from 10 to 9.52%. Again, as bond yields increase, bond prices increase, bond yields reduce. As bond prices decrease, bond yields increase. So inverse relationship, right? So these are the basics of how bond prices and bond yields are related, and they are related with each other in inverse proportion. Right? Now let us try to understand how would rate of interest or policy rates in the economy would change or impact the bond yields. Now let us consider the first scenario. If there is an inflation in the economy, whenever there is an inflation in the economy, that central bank of that economy would increase the policy rates. For example, in India, RBI would increase repo rate. In US, the Federal Reserve will increase its equivalent of repo rate called as federal fund rate, right? So similarly, whenever rate of interest rises in our economy, banks are required to offer higher rate of interest to its customers on their deposits. Now, let us make an assumption. Before this policy hike was done by the central bank, bond yields as well as rate of interest in the economies were same. And you being an investor would have an equal good opportunity to invest either in these two financial instruments. But now, after increase in rate of interest, suppose this equilibrium gets disturbed and rate of interest becomes more than the bond yield. So any logical investor who wants to invest his money and has two options, either depositing it in bank or investing in government bonds, would rather prefer to invest or deposit his money in the bank account. So as a result, because of increase in rate of interest, the demand for deposits increase, and correlation with it, the demand for bonds reduce because deposits offer a better avenue for investors. So when demand for any commodity decreases, you can understand its prices decrease. So the bond prices would reduce. And what is the relation between bond prices and bond yield? Bond prices and bond yield are inversely proportional. So when bond prices reduce, bond yields increase. Right? Now let us consider another example. It will help you understand this concept in a better manner. Suppose there is a recession in the economy. So what would the central bank do? It would reduce the policy rates, right? So whenever the policy rates like repo rate or federal fund rate reduce, the banks in that economy would rather prefer to give lesser rate of interest to their depositors. So when rate of interest reduces, the rate of interest now becomes lower than the bond yields. Now again, if you are an investor who wants to invest money and you have two options, depositing them in the banks or investing in government securities, you'd rather prefer here to invest in government securities. Why? Because they are offering you a higher rate of return. So demand for deposits as a result reduce and demand for bonds increase. whenever demand of any commodity increases, you can understand its prices also increase. So as a result, bond prices increase, and we have understood the correlation between bond prices and bond yields. They are inversely proportional. So when bond prices increase, bond yields go down. So what did you understand from this? That as policy rates and rate of interest increases, bond yields also increase, and when policy rates and rate of interest reduces, bond yields also reduces. So bond yields are directly proportional to policy rates and rate of interest. Understood? Now let us try to understand how this policy measure would impact Indian economy. We have understood as policy rates have increased in US, so US government bond yields have increased. So I have established, or I have proved what was written in that write-up. Now let us come back to the moot point of our today's discussion, how it would impact the Indian economy. Now, higher rate of interest in US can potentially lead to more foreign outflows from the Indian capital market, that are stock markets, because the yields on US government bonds called as US treasuries, they are more attractive for foreign investors. And as higher bond yields in US, they also reduce the attractiveness of Indian bonds of foreign investors. So how this basically works? Let us now try to understand that. Now let us imagine before anything happens in US, the yield rates in both countries on their respective government bonds are same. Now let us consider what would happen if there is an inflation in the US. Whenever there is an inflation in the economy, their central bank would increase the policy rates, and as a result, the rate of interest in that economy would increase. And this is what exactly will happen in US because of the US Federal Reserve's policy to counter inflation in US. So when policy rates and rate of interest in US economy increases, the US Fed Bank would like to suck out the dollars from the market, and to suck out dollars from the market, US Federal Reserve would sell their government securities in the US market. So when US market is oversupplied by US government securities, it would push the demand for bonds below, and therefore bond prices of US government securities reduce, and thereby their yields also increase. So initially I told you, right, before the start of this equation, when the bond yields were same, this equilibrium will now be disturbed, and as a result, because of increase in bond yields of US bond yields now become higher than the Indian bond yields. So therefore, in comparative terms, now Indian bonds become less attractive for investors. So when Indian bonds become less attractive for investors and US bonds become more attractive for investors, where would investors prefer to invest? Yes, in the US government bonds. So when US government bonds become more attractive, it would lead to foreign portfolio investments outflow from India, because they will sell their holdings in India and rather prefer to invest in US securities market, right? So as a result, the demand for dollars in Indian economy increases because they want to sell their investments in rupee, take out their dollars out of Indian market, and comparatively, the value of Indian rupee would fall down. And when value and demand of Indian rupee would fall down, this is called as rupee's depreciation. So the first impact of rise in policy rates in US is what? It leads to rupee depreciation in India. Now, whenever there is an increased currency outflow in US market or from Indian market, RBI would like to intervene in order to establish this equilibrium. So RBI would sell dollars in the Indian market in order to balance out the rupee depreciation. So where would RBI sell this dollars from? It would sell this dollars from its forex reserve, and as a result, the forex reserves of RBI would also decline, which is, you already know, is happening. Now let us understand how this impact yields on Indian bonds. Now, when investors would sell their Indian bonds, naturally the demand for Indian bonds reduce. So when demand for Indian bonds reduce, it leads to reduction in bond prices, and you understand relation of bond prices and bond yields, they are inversely proportional. So bond yields in India rise, right? So what are the overall impacts of this move on Indian economy? Indian economy will face rupee depreciation, that is erosion in the value of rupees. Indian economy would face reduction in its value of forex reserves of RBI. And at the same time, bond yields in Indian economy after US government's bond yield rise would also start to rise. And as a result, government borrowings going forward would become expensive. Your floating interest rate loans, which is linked to government bond yields, will naturally increase because government bond yields are increasing. And when government borrowing becomes expensive, your rate of interest on loans become expensive, the amount of investment in Indian economy would decline. So this is what is called as a negative impact of US Fed rate hike on Indian economy. And this policy of US Fed Bank, when it increases policy rates in order to reduce the money supply in US economy, that policy is called as Fed tapering. And this negative impact on Indian economy is termed as, or are termed as, taper tantrums. Understood? So this is how this will negatively impact Indian economy. Now, you need to understand that presently, even before the Fed rates actually have been hiked, Indian economy is facing pressures due to outward movement of the foreign portfolio investment. But why are foreign portfolio investors selling their investments from India? This is because of high crude oil prices, because high crude oil prices increases India's trade deficit, and this would mean erosion of RBI's ability to fund this deficit. Similarly, uncertainty in geopolitical environment, primarily due to the wars that is ongoing in the Middle East and in Russia, Ukraine, has eroded the investment climate not just in India but worldwide. Similarly, rupee is facing downward pressures. It has become weaker due to return of foreign investors, earning less in terms of rupees. Similarly, underperformance of Indian stock markets have happened because Indian companies are not investing that much in AI. So the confidence of investors on Indian markets have reduced, and this has started the outflow from India. And going forward, if US ends up increasing its policy rates, you need to understand this pressure would only increase, which would translate into higher outflows, reduction in the forex reserves, and reduction or depreciation in Indian rupee, right? So this was all for our today's discussion, and foreign portfolio investors have already sold this year much higher than what they did last year. Last year they did about $12 billion worth of selling in India. Now, in the span of 6 months remotely in India this year, it has been more than double of what was last year in the entire year. So this is why I've told you this impacts Indian economy in a negative manner. Right? So this was all for today's discussion. The kind of discussion we did is a discussion we actually do in the classes. So you need to understand Indian economy is a technical subject. So you have to go into details in order to understand how one factor happening in a developed economy like US would affect emerging economies like India. So for similar kind of discussions, what you can do, you can take admissions in our GS-P2I foundation batches, where not just economy, but polity, history, geography, and other subjects also are dealt with in much more detailed manner, just like I did with this particular topic today. Now, this topic is very important from our exams perspective. Let us see how it is important from our exams perspective. Look at this question which appeared in UPSC prelims exam of 2021. Indian government bond yields are influenced by which of the following? From our today's discussion, it would be very simple for you to solve it. Please do let me know the correct answers in the comment section, and if you like the way I've approached this topic in a video, do let me know in the comments so that I will do the similar kind of videos in future also. Okay, and if you want to download the notes, they will be made available on this particular Telegram channel. It is called as ETS Live, and I understand Telegram is up and running now, so the notes will be made available as soon as this video concludes. Okay, so this is all from my side. Please have a very good day. We'll see each other again tomorrow, and have a very good night.